everyone, welcome back to Finance Brand channel. So I met this couple, Amy and John. They're discussing whether to buy the mortgage points. So in today's video, I'm going to introduce you what are the mortgage points, and also I'm going to give out examples because the number really show you whether to buy or not. All right, let's dive in. So what are mortgage points? Mortgage points are also known as discount points. They are upfront fees that pay to your lender at closing. Each point is equal to about 1% of your loan amount, according to different banks. There are two types, discount points and original points. Discount points lower your interest rate, but the origination points are fees that you pay to the lender for their service. So today we are not talking about original points. We're really talking about the mortgage points. Amy wants to buy it, while John doesn't want to buy the points. Is it a good idea to purchase points? Well, if you plan to stay in your home for a long time, then purchasing points can be a smart move. It can significantly reduce your monthly payments over the life of the loan. By investing a little bit more upfront, you can enjoy lower interest rates, saving thousands in the long run. So whether you are a first-time home buyer or refinancing, consider your future plans. They play an important role in your decision. If you plan to stay put, for a long time, the mortgage points might be really worth it. It might be the key to a more affordable ownership of the house. Make informed decisions and turn your dream home into a reality. Your future self will thank you. But on the other hand, while the mortgage points can be a good smart move, a wise investment, sometimes it's not worth it. In what kind of scenarios is not worth it? All right, let's go over to the examples. Okay, scenario one. So this couple is going to buy this house. They have the loan amount for $200,000, and their interest rate, they have a really good credit score, and the interest rate is 3.25% without the points, and they want to purchase 1 point. It's 1 point costs about 1% of the loan amount. So you're going to see 1% of 200,000, that will be $2,000. So 1 point that will reduce the interest rate. Remember, it's not like a 1%, it would reduce the interest rate by 1%. Usually it's by 0.25%. So that would be from 3.25% reduced to 3.03%. And the monthly payment before the points is about $870. And with the points, it's about $843. So that's like monthly savings of $27. I see how long it takes to break even. So how you calculate that? You will use the cost of the points amount, which is $2,000 in this scenario, divided by the monthly savings, which is $27. And that would take about 6 years and 2 months to break even. So if this couple, they plan to stay long there and not refinance anytime soon, then it will be worth it. Let's go over to scenario 2. So this couple, they kind of want to, shop around for their second house. They kind of want a better house. They will to, they do want to stay in the house a little longer than 6 years. Their loan amount is $400,000, and the interest rate without the points is 6.35%. They still didn't straighten out their credit score, so and the interest rate is pretty high. So when they got 6.35%, and the loan with points, they want to purchase 2 points. So 2 points that would reduce the interest rate by about 0.5%. So which would become 5.85. So 2 points, it will cost them about $8,000 because their loan amount is $400,000. And the monthly payment without the points is about $2,488. And the monthly payment for loans with the points, 2 points, it's $2,359. So that would give them monthly savings for about $129. Okay, let's see how long they would take them to get break even, to recoup those costs. that will be about 62 months. That's a little more than 5 years. So they do plan to stay there at least like more than 6 years. So I think they will be okay in this case because they plan to stay there. At least they recover from the cost. At least they got to stay there for more than 5 years for the cost to be recovered. Okay, let's take example 3. Okay, let's look at example number 3 with a different loan amount. So the loan amount is 320,000. Number of points they want to purchase is 4 points. The original interest rate is 4%. So if they want to purchase 4 points, that would reduce the interest rate for about 1%. So 4 reduced by 1%, that would be 3%. And how much it will cost? The loan amount is 320,000. 4 points is 0.4%. 4%, that will be 0.4 times 320,000. That will give us, that will be 12,800. And the monthly payment without the points, that will be 1,527. And the monthly payment with the points, it will be $1,349. So how much that save monthly? About $178. So how long it would take for them to recover the upfront cost, this cost of purchasing points. So we use cost of the mortgage points, which is 12,800 divided by monthly savings, which is $178. That will give us 71 months, about 72 months, which is a little less than 6 years. So they really need to stay there for 6 years or not refinance, like at least, 6 years for it to be worth it. So I hope it really helps you those different scenarios. So if you have if you plan to stay there longer and you could afford a little bit upfront cost, then it might be worth it for you. It could save you a lot of interest money if you're in this kind of scenarios. But if you plan to move, upgrade your house, or you have a relocation coming up for your job, then you really got to be very careful with purchasing points because it might not be worth it to cover those upfront payment, those prepayments. I hope this helped you. Please subscribe for more financial tips to my channel.